right? I am joined by a distinguished group of panelists. All of the panels really, it seems like, have been focused on Europe, but this panel is actually the European panel. It is called The Unraveling of Europe. We have Edward Altman. He is a professor at NYU Stern School of Business. We have George Papamarkakis. He is the CIO and managing partner of North Asset Management. And of course, Davide Serra, the Italian among us, who is also from London. He's the founding and managing partner of Algebris Investments. Let's start with the news. Europe has dominated every single headline. Olli Rehn yesterday, EU Monetary Affairs Commissioner, said 10 days we have a self-imposed deadline to solve this crisis. Here we are. This will be the 15th crisis summit after 2 years. 10 days. Are investors really going to be buying that? Davide, you're the optimistic one.
I think there's two reasons why in 10 days is probably about right. We think the date is the 8th or the 9th of December. And
this is the Brussels summit.
Yes, and there are two reasons. One, there's an ECB meeting on the 8th. 9th, there is the Brussels meeting. But most importantly, because you have Christmas on the 25th. And if nothing gets done between the 8th and the 9th, as in August, the key trade happened from the macro community was, well, every EU politician will be on holiday on the beach, certainly in Greece and Italy and Spain. It will be impossible to call a summit. The ECB is not acting as lender of last resort. Let me have a go and try to push every bond market possible. And as a result, because the probability of system failure increases, as the system freezes, you can have total failure. And hence, I can't believe that they're not going to come up at least with a massive liquidity solution for the financial system in terms of the banking system, which at least will buy time for the political process to go through. Right now in Europe, what we had is the market timing, the political timing don't go in sync.
Right.
The market behaves, I got 4 kids, they behave like more 4 kids. I want to have a candy, I want to have a candy today. It says, okay, have your food and then you can have a candy. The market says, no, I want to have a candy today. And in Europe, that's not the way it's going to work. So you're going to see, in my view, that the process will improve. You already had enough declaration from Merkel, Sarkozy today speaking at 5 in Toulon. Tomorrow morning you have Merkel presenting. And hence I think by Christmas we have a solution where the dream of the Anglo-Saxon world to see a euro break cap, just because it's great, it's unlikely at least to manifest itself by Christmas. And we'll see.
Well, there's so many directions we could go in. But George, let me ask you, because you are he's an equities guy, you're fixed income currency at North Asset Management, perhaps the investors that want candy, and you're more bearish.
I'm more bearish in terms of the immediate outcome. I don't think we're going to get anything comprehensive on the 9th. I think if you look at what Merkel has said, actually, she continues to reiterate that this is a long, drawn-out process. I do think we're going to get something, on the banking system, which is has a very big problem in terms of the liquidity it's facing. But in terms of getting any, I would say, solution on the 2 most important issues, which is 1, some type of a fiscal union, and 2, some type of a more concerted and sustainable buying from the ECB. I don't think we're going to get anything concrete. And I think actually...
I agree. Listen, every time we've seen some incentives and actions on the part of the politicians or the central bank, et cetera, there's been this initial euphoria. Yesterday was a great example. And then the reality sets in that the fundamental problems have not been addressed. So what are the fundamental problems in Europe right now? It has nothing to do with the political problems. They are growth of the countries involved. And I'm fairly negative about the situation until they address growth in these countries and do it in a very forceful way. And they're not doing it now. They're talking about austerity. We looked at the probability that the crisis would leapfrog from Greece and Portugal and Ireland to some of the larger, more important countries like Spain and Italy long before it happened. And we weren't looking at anything that the macroeconomists tend to look at: debt to GDP, deficits to GDP, unemployment, productivity, etc. All the macro measures we're used to seeing. What we were looking at is the fundamental health of the private sectors in these countries and the ability of the private sector to increase profits, pay more taxes, hire more people. Until they address that situation, Europe will be constantly back in a crisis. And yes, there will be much better cohesion on the part of the most important countries coming out of this next summit. And that will pacify the markets. But then what happens when they say Italy has dropped GDP by 3% and Spain by 5% and Greece didn't meet their targets? And then the reality will set in that I don't care what the debt level is, they still have to meet those payments and they don't have the revenues to do it. So I'm looking for people like Mario Monti and some of the other new politicians to address the growth situation, which they know about, but now they're hamstrung with the debt situation first.
And you say it relates to the private sector. It all comes back to the private sector. Interesting, because Davide here has been long European financials, SocGen, Intesa, stocks that have been absolutely hammered, but you still have conviction.
Yes, and I think the reason is, let's put it this way. I'll give you the way the Europeans think about it. So you're based in Europe. Italy, or take an example, other countries, Spain has a public debt to GDP of 50. Italy was at 100, primary surplus for a couple of years, 20% reduction in GDP. And all the, let's say, health care, unfunded liabilities already in the numbers. Why? In Europe you have the pension system which has full unfunded liabilities in the numbers. As you know, in the US, 7 times of your GDP will be future liabilities because you have younger population growth. So growth comes also with future liability as people get older, and then maybe you have to treat them in hospitals and give them pensions. Now, which is you're dealing here. And what happened is suddenly they saw 3 trillion euro of AAA assets rated by S&P and Moody's, which I think they're protected by the Fifth Amendment, which basically is more than all the, it's about 50% of European debt, suddenly becoming 20 cents on a dollar subprime. They get hit. And what happens, the European, the way they react, it's not what I call easy. The easy solution is go to the printing press. The Fed printed 20% of the GDP, UK did 20. As the dollar area is linked to the commodity area, basically I have 70% of the world today is going easy, print 20%. What Europe has done? Don't print. If Europe had printed 20% of the GDP, we would have been able to buy all Greek, Portuguese, Irish, Spanish, and Italian debt. All yours. There's no discussion. Today we wouldn't even have a panel. Now, I can't believe that the only...
And they're still holding out. Mario Monti,
exactly.
Mario Draghi today.
Yes. So let's put it this way. If you want to have easy candy, like my kids want, yeah, easy candy is easy. Just go and say, go, do what the others have done. Now, what's the European situation? So it's okay, we know that this, at the end of the day, ain't going to fix anything, yeah? Because as the guy before me said, it's just basic devaluation. Everybody talks about the breakup. I well remember when I was in university, the euro-dollar conversion was at 1. PPP 120, we're at 135. People saying 10 days the euro breaks up and we're 35% higher. When I come from London, the euro tends to be more,
let me
richer.
ask you that. Is that because the ECB has not printed? Is that why the euro is so resilient?
That's part of it, but that's a conundrum that I can't figure out either, why it's 135, to be honest with you.
George, do you know?
I've been short euros for a long time, and like you, professors like to tell you what to do, but we're not necessarily great investors. So just as long as I'm short euros, I guess the euro is going to do great.
Well, I think
George, why is the euro
people
so
don't
strong?
appreciate that Euroland as an entity is actually in a much better state than the U.S. and actually, of course, Japan as well. You have a country, you have an area which is, has a debt to GDP, which is roughly 70% compared to 95% for the U.S. The fiscal deficit is around 4% compared to 9% in the U.S. So actually Europe in total is doing okay. The problem with Europe is the political impasse and the fact, of course, that public debt is not fiscal, is not federal, but it's on a state level. And that is something which needs to be addressed. So in terms of the euro overall, it's difficult to see, as long as you have Germany, which continues to make products which the world needs, it's difficult to see the euro weaken substantially unless you get, of course, I would say some type of systemic shock, which shouldn't be excluded.
By the way, Sarah, I sound bearish. I actually have been on record to saying that Italy will save the euro, not just because he's on the panel either, because they have some real fundamental comparative advantages that Greece doesn't, that Portugal doesn't, that Spain doesn't. And I'm not sure how these countries that have no comparative advantage and now tourism is pretty much shot, how are they going to survive over the long run? You've got to pay your bills by having reserves and people wanting to buy your products in one form or another. This is a dream that this whole thing is going to save Greece. So until they somehow convince me that under this bailout or this great new society that they're talking about coming out of the new funds, how is it going to salvage what looks like a pretty grim situation going forward for a number of these countries? But Italy, I felt, was going to be, you know, like the little boy who puts his finger in the dike and holds it, because they have tremendous advantages. They got all sorts of problems, which they're now addressing. Political, that seems to be partially out of the way. Although, you know, I don't think we've heard the final situation with respect to Berlusconi and his influence on what happens in Italy going forward. But I'm very optimistic about Mario Monti and what he would like to do. Whether he can do it, given the situation, is a different story.
Well, investors were optimistic too, but he was elected, he's in power, he's won the confidence votes, and you still have an Italian 10-year yield.
Isn't it great that a professor can go 3 days
Economists
later be the
should rule
prime
the
minister
world.
of a country?
And,
I think Italy's really got it right.
But despite your enthusiasm and optimism, the Italian 10-year yield is above 7% and has been moving up ever since. I mean, George, you're a bond market investor. What do you need to see out of a country like Italy so that it makes the euro and does not break the euro?
Well, I think there's two issues. One is a long-term issue, which is issues of supply side, which I think are to a certain extent being addressed, and that applies to Spain as well. And then you have a medium-term meaning or short-term meaning somewhere between the next week and the next few months when there's a huge funding problem for Italy and Spain. And unless you get something very substantial, either from the ECB or some type of federal commitment on Italian debt, I see it very difficult to change the situation.
It all comes down to Italy, but Spanish yields are not far behind Italy's yields. French yields have already started rising, and everybody thinks that it will be the next country to be downgraded.
It already is.
In the eyes of the market.
Yeah, exactly.
I mean, do we need to worry about France also?
I think there's, let's make a comparison so that everybody gets it here. So in the States, you have 51 countries, yeah? One is Puerto Rico. Yesterday, I was watching the TV, and suddenly the Prime Minister comes up and says, this is a holiday resort destination. There's about 4 million people living in Puerto Rico, and Greece 8, a bit more. Why did Greece join the euro? It was basically a geopolitical decision. You have the Balkans, you have the situation in the Middle East not clear. So if you actually look at the European map, I know it's small, but actually Greece has no border with the rest of the European Union. And there is a reason for it. Geopolitical, it's called. Have they cheated the numbers? Yes. Have they cheated the statistics? Yes. Perfect. Now, if someone believes that if tomorrow Puerto Rico was to leave, why was Puerto Rico in the 51 states? I think it's because close to Cuba, it looks like, at least from the European perspective. And if you believe that you take the productivity of the states, which is more in the context of the European Union, you can make a geopolitical decision. The European project in 1960 was created because Europe twice in the last 100 years has destroyed 90% of the capital installed productivity. Yeah? You had bombed every bloody city. Secondly, you destroyed 2 generations of young people. So typically it's hard to compete in the long term where, you know, every 30 years you destroy every human being you have, productive, and you obliterate your industry. So they said, it doesn't look like a smart decision going forward. So it says, why don't we do like American? Yeah? Looks smart. Join in a federation. And here, at the beginning of the federation, if I well remember, there was a bit of a social tension a couple of 100 years ago. So the process is unstable, but it's moving in the right direction. Why today I think we're going at the end? For 2 reasons. One, on financials. The ECB in its own mandate has financial stability. And then there is another article 125, no bail-in clause. Basically, the ECB cannot actually buy, like in the Fed, the paper that the Treasury issue. Okay, now, the first comment, financial stability. stability means stable. And the etymology comes from table, tavolo, stable on it. So you want to say it stable. Now, so the ECB will say, do I see anything stable in financial markets? I have 17 yield curves. I have house prices down 20. My monetary transmission process, that's why they care about inflation, it's broken. Why? Today, you travel across Europe, yeah? It's easy. You just drive, you fly 2 hours, 3 hours by 3 hours, yeah? And you have
The
done
train
Europe.
is pretty good, too.
Exactly. They go 3 times faster than the Amtrak. And what happens is, as you travel through Europe, you get a situation whereby you don't have a single yield curve. Every bank, every shop has a different rate. So the ECB has failed, de facto today, because of the credit risk in its own mandate, financial stability, monetary transmission. So I think they will act as lender of last resort to banks, which we already have. Make no mistakes, have any of you in the US lost money holding their own deposits, segregated accounts in Europe? Has anyone has done it? Please raise your hands. I can tell you as of last week, I have 2 people which were based in Europe which lost the money with MF Global. They lost money in Lehman. Their own money, deposited in London, deposited in Germany. So this view, and that's actual fact, yeah? As a result, I think the ECB will draw the line for financial stability in financials and will make sure that the politicians are on the hook to do all what Professor said, which is absolutely right and is correct. And up to now, the politicians, like in America, I think, had an easy go. In the States now, 50% of Americans don't pay taxes. That's, like 50% of GDP in Europe being public. What it means, the government has an incentive to buy votes. So what does it do? It promises jobs.
But it's only 8%. The 50% who don't pay, if they did, would only add 8% to the payroll. In Italy, it's like a third.
Yes, and because the Gini index of wealth dispersion is less. And that's a society decision. Do you want to have billionaires and people on the street, or do you want to have
There's a lot of wealthy Italians too, I tell you. And actually, one of the great strengths of Italy is the wealth of the private sector, both the consumers and the corporates. And so the risk is, or the potential is, that they will continue to channel their wealth into Italian government bonds and similar securities, as opposed to a flight of capital. And so it's very important for the Italian population to have faith, as Davide does, in Italy. And that's why it's so important for Italy to have a positive outlook. And it's all, I think, changing for good in terms of the political situation, to have that positive outlook, and there won't be a flight of capital from Italy to other countries and a run on the bank. This could all happen. I mean, this is the disaster scenario of a run on the banks, people getting their money out of Italy and putting it in Switzerland, et cetera, because of the fear that this is getting out of hand. And, when it comes down to self-preservation, it's my capital and where I want it to be safe, not where the politicians want me to put it. Up to now, it's worked in Italy and countries like that. But I'm afraid those countries that don't have the ability to sustain themselves over the long run is going to bring down the euro. And we need to have somebody like a country like Italy saying, no, we can do it ourselves, although, of course, in the short run, we need the support of the politicians.
Well, George, jump in here. You run a lot of money. I mean, where do you feel safe in Europe right now, if anywhere?
Well, I think the issue is, again, we're looking at Europe from 2 different perspectives. One is the long term, where there's these issues of supply side and the reforms that need to happen. But I think those are not what investors are thinking about right now. What investors are looking at is that there's a huge amount of government bond supply coming into the first quarter, and there's no natural buyer. So this isn't about capital flight. This is about a buyer strike. And that's where you need to have effectively an entity come in, a buyer of last resort, which we don't have in Europe, and stabilize the situation. I don't agree that the issue is the banking system. The banking system is a symptom. I think it needs to be addressed, but it doesn't solve the fundamental problem, which is the fact that people don't want to buy Italian debt unless A, it's guaranteed by the European Union, or B, it can be monetized. And both of those things are not on the table for the time being. And until those are addressed, I think you're going to continue to have this confidence crisis.
What happened to the EFSF? That was supposed to be a guarantor of some sort. It was supposed to be €1 trillion.
That's another good example of how you're seeing this huge political impasse in Europe, where you have this entrenched position of Germany, which doesn't want to monetize its debt, or the European debt, and the rest of Europe, which is trying to push Germany towards that road. And I think, as a previous speaker mentioned, I think until the situation gets to a point where Germany starts realizing that if the situation gets that bad, then their banking system's at threat, and potentially the costs are much greater than which I think they will realize in time, the costs are much greater than the mechanism that they're going to have to put in place, we're not going to get any solution. But I don't think we're at that point now.
And Ed, the final question here is this goes much farther than just the crisis response, because there's an issue of growth, austerity. Does it work? What does it look like in 1 year? Look at what it's done to Greece.
Well, austerity has worked in the past, but it's worked in societies where they're much more disciplined and structured. South Korea in 1997 was on the verge of default. They got a $50 billion bailout from the IMF, which is what they needed to sustain themselves and keep from 3 or 4 of their large banks failing. Then they had the austerity programs, and the society was disciplined enough to turn themselves around. The financial system was completely revamped, and the banks were restructured. Is that possible in Greece? Is that possible in Spain and Italy, even at the extreme? I have some doubts about that. But the near term is going to be, these austerity programs will result in real negative GDP growth and recessions. You know, I've never seen a Fed official, with all due respect to the prior speaker, be up to date in predicting the recession. They're always optimistic. And the same thing about the ECB. But now we're seeing out of Europe, OECD, et cetera, very dire predictions about the near-term growth. And how can they grow when they have austerity programs and already on the downside? The question is, how bad will the statistics be, and whether or not they'll be, Mario and others will put into place not only austerity programs, but incentives for the private sector to be productive and effective. I have an index. It's the probability of default of the average company in each country. And what's the current situation? Greece is on the bottom. The median probability of default of a Greek company today is 15% over the short term. Now, 15% is a high probability if it's the median level. 75th, 90th percentile is going to be much higher. Second, Portugal. Third, Ireland. Third, Italy. Fourth, Spain, and fifth, Ireland. In that order. And that's exactly as the CDS spread is today, looking at the probability of default of the sovereign. So my feeling is you need to combine measures of private sector health with public sector health in order to get an effective early warning prediction model for sovereign health. And we think we're on the right track, but we're not there yet with our models.
All right, this portion you saw in a previous panel. We asked each of the panelists the same question, and they are going to reveal it. The question is, at this time next year, which country or countries will no longer be in the European Union? And there's a distinction because the European Union is bigger than the Eurozone, which are the countries that use the euro. Okay, European Union, which countries will no longer be? Davide? Everybody can reveal.
Yes. I give 0. I asked, by the way, specifically European Union or the euro, because it wasn't clear. And
European Union.
Would your answer be different?
For the European Union, well, first, it is different.
It is? Oh,
it is today. It is on the treaty. There's different legal contracts. And there is a reason, because there's no way that even if someone wants to leave the EU, they can probably fast track given the law.
Yeah.
So given how long it takes, certainly won't happen in 12 months. If you were to ask me, will it happen in 3 to 5 years, I tell you, let's see by Christmas what they agree. And the reason, and hence, maybe my answer might be different depending what happens over the next, let's say, 2 to 3 weeks on the path.
You're talking about 17 or 37 countries we're talking about here?
We're talking about the 27 Euro
27,
EU,
sorry.
yeah. European Union.
I was thinking 17.
Yeah, I have a small 0, which probably reflects my the probabilities rather than the large 0, which
And
I think
there's no smiley face in here.
and there's no smiley face. I still think it's 0, but I think we've started a process in Europe which, unless we get a dramatic reversal over the next few weeks or months, we've started a process of disintegration, unfortunately.
Okay, so
Well-
you're answering the euro question. We can do that.
Okay.
That's the 17 that use the
So
euro.
I have a binary answer.
You're an economist.
All or zero. I don't think you can see this so well. Leaving would be maybe 20% probability, and zero leaving 80%. So I'm still bullish, but I think to say that there's no chance that the union will break up, is a fantasy.
12 months.
12 months. That's an interesting point. I hadn't thought about the 12-month point, but let's,
But you're shorting the euro.
Yeah. This is my way of making it.
Okay, I want to open it up for questions.
Can I just make a comment?
Excuse me.
There's two, just for political debate. First of all, why does Germany is obsessed with the printing press? Historical reason. Twice the governments went to the printing press and financed World War I and World War II. So in the Constitution, they said, okay, no ever a government can go to the central bank and go to the printing press. Secondly, they said no government can go and bypass parliament, because that's what happened in history. So that's why they put the Constitutional Court. Now let's be clear. If today we were to do what the US and the Bank of England has done, and what the Swiss National Bank has done, which to a German Orthodox, it's a shock. In Switzerland, which is the dream of what an Orthodox German would love to do, they decided to throw 100 years of history of monetary discipline into the garbage bin, and in 2 weeks, they doubled the balance sheet. So it's like in 2 years, you eat more what you had in the last 100 years. Now, they've been pragmatic. They were losing jobs, and they said, no matter how good we are, at €1.20, €1.05, we die. At 1.20, SMEs in Switzerland are still exploding, and exploding faster, actually, than in Spain, Italy, and Portugal today. So I don't know your index, but I can tell you today, there's more default in Switzerland right now. Why? They can't sustain the competitive. So I think right now there is a bit of a currency world globally going on. And what happens is, if the euro was such a disaster, you tell me how it can keep on being so high. It's the most liquid assets in the world. The central banks cannot buy it. It's real actual transaction. You sell a Mercedes, you buy an Apple. Yeah? That's what happens in the world. No money manager can manipulate. There is no flows, inflow or outflows. It's real economy. It's oil versus goods.
Yep.
And the second point is the monetization eventually one day will happen. But when it happens, it's on real strong fundamentals. Because I think it makes no sense just to play the printing game, to be easy.
What I don't understand is how can you have
Quickly, because we want to get some questions.
how can you have investors still thinking that the probability that Greece will default is 95%, that Portugal will default is 60%, that Italy will default is 35%? This is the implied probability from the CDS spread. How can you have that happening, and at the same time, you have this super strong euro situation? I just can't understand how one set of investors are so much different than another set with respect, because we know if they all default that the euro will tumble.
It's all within the EU, because the main creditors of those countries are within Europe. And that's why the banking system's got this huge problem. So on a Euroland level, actually, the current account is roughly flat. Compared to the US.
We got to get questions.
We'll
Steph
go to
has
our
a good one.
questions from the audience. And Davide, once they start monetizing, when will it end?
Well, first of all, I think let's be pragmatic. Right now, if I look at in Europe, there is 33 trillion euro assets, 15 trillion of GDP. What has been so far what you can call liquidity provision? Less than 600 billion euro. That's the expansion of ECB balance sheet. And if it were to follow the EU and US and UK model, which is 20% of your GDP, should be 3 trillion euro, which on today value is about $4 trillion. So they could basically go up to $4 trillion. That basically buys 100% of all the probability to default you calculate with the CDS in anything you want to do. And you don't count the market value of the countries in AAA, which are now trading at 100, 105, 110 on the bonds. So we only look at the bad and not at the pluses.
If CDS on these sovereigns was banned, if it no longer existed, would we be in a different situation?
George, why don't you take that? That's
Definitely
a good question.
not. It wouldn't really change anything. I mean, the CDS market it's definitely an imperfect market, but it's by no means the market which is dictating, if you like, spreads.
Do you
Yeah.
think we could see a credit event? I mean, failure to pay is a clear credit event, and if we come to that, there's no avoiding it.
I think there's a very high likelihood in the case of Greece that we do see a credit event. It's running out of cash on a day-by-day basis. There's very little, I think, political commitment in terms of foreseeing or keeping Greece alive until effectively March. So I think there's a high probability.
Yeah, isn't it kind of ironic that what determines a credit event is based on 15 people around the table all having a vested interest in the result, making a decision? I think the CDS market is in deep trouble in terms of its credibility because of the fact that a credit event is going to be determined by the big banks as to whether or not it happens. And if you have to write down 80% as opposed to now 50%, are you going to vote for it to be a credit event? This consensual thing is a joke. But at the same time, it's important because having those bonds as collateral for the Greek banks, etc., is dependent on whether or not there is a default, quote, default or not.
Do you think the big banks know what their European exposure is?
You're
The EU. Well, I know that people don't like numbers, but you can download on the, when the US stress tests their own banks, the only numbers you and I got were 20 numbers. In Europe, you have 3,200 numbers per each institution. And they're all public, and you had 2 series in 2 years. And you have done it on 100 banks rather than on 16. So in US, I got 180 numbers. In Europe, you get 32,000 numbers. Now, you might not like it, but you can analyze anything you want. The point made before of the payment system, which is true, in Europe, basically, the plus and minuses and the imbalances of the current account balances are then reflected in the balance of payments through central bank credit and debit. Meaning, when a French guy buys a German Mercedes, no cash moves. What happens is he gets a minus on his Société Générale account that goes in Banque de France, and he gets a plus on Bundesbank, and then goes in Deutsche Bank Mercedes. Now, no cash has been transferred. So that's why it's all within the system, which is one of the reasons why I think, as at the end of the day, it's all their money already. Whether they think it is or not, because of the payment system of the central banks, that's why they will work together in making it fixed. Because the loss will only be their own loss at the end of it.
Here's a question for you. If you're so bullish on the banks,
I've never heard anyone defend the credibility of the European stress tests, by the way, like that.
yeah.
Sorry, the
But
European
I think that's the whole point, is that we really don't know exactly how this whole thing is going to play out in terms of, yes, you've got the numbers, but what we've seen in the U.S. or in the world in 2008, the actual effect of a default of Greece, for example, and the knock-on effects in terms of liquidity are substantial, and they're very difficult actually to risk model.
And I'll give you the last word.
Well, one thing to look at is if we have a shock and a systemic potential event, which bank or banks in Europe or could be in the United States are most vulnerable in terms of how much capital they need to raise to remain solvent. And we, 3 of my colleagues, including a Nobel Prize winner, have just come up with a new index for systemic risk of financial institutions. And I can tell you that the 2 highest on that list are major banks, and you probably know who they are, in Germany and France.
Why don't you name them for us?
Oh, it's Deutsche and Paribas. But the point is that, they're big, strong banks, but if there is a shock, they will have to raise tremendous amounts of capital to remain solvent. And the only place to rely upon then is the sovereign, Germany and France. And what that does to their credit rating is the big question.
Okay, and we're at the 0 mark for time, so thank you very much for our panelists and for the audience.